Alrighty. So thank you everybody for joining the 101 session for the bakery and Skylit partnership. First of all, bakers, congratulations. This is a pretty incredible feat for the first week in business and pretty excited to see all of you make money. Yeah, I've been working with and kind of, hanging with Breadman for a while, and he's definitely one of the top traders in the game. So I think you guys are in really, really good hands, and I think everybody is gonna really enjoy their time in there. So, for us, we're only hoping to continue to add value. This is the second official partnership that Skylit has, and generally, like we're pretty selective with regards to who we partner with because with any complex or powerful tool, like it's only as good as the person wielding the tool. So generally, like I do a lot of screening before, I determine if I'm gonna, partner with a server or a community member or not. And yeah, Bakery definitely fit the bill. Like I think Breadman is probably one of the top SPX traders that I've run across in the market. He's got a really good overall knack for being able to swing trade. He's great at sniping reversals. And most of all, he learns really, 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 really fucking fast. Like when I put the tool in his hands, like it was pretty incredible, like how quick he was able to learn and pick it up. And not even that, like I didn't even have to like teach him. Like he was just watching the replays and, he was kind of, finding his own way of utilizing it. And I think that's just a pretty incredible feat. So. I'll go ahead and start with that. I think in terms of the overall agenda today, for the 101 sessions, I don't go too complex into the product, okay? First of all, like Skylit and Heatseeker is a very, very complicated product under the hood. But the most important thing for me launching any tool is that instead of going too deep into the mechanics of how it works, the most important thing is that people understand how to interpret it and they understand how to apply it to their day-to-day trading and their day-to-day strategy without going through a rabbit hole and getting caught up in like, analysis by or paralysis by analysis. Okay. So this is called a 101 session. It's called a 101 session because it's meant to be simple. It's expected to be delivered in layman's terms. I'm not going to go into like the second order Greeks or the third order Greeks, and I'm not going to like go into crazy complex, like structures of what I'm discussing. Like I'm merely going to tell you how the app works, why it works, and how you can go ahead and apply it to your day-to-day trading, okay? Like just because I'm speaking in elementary terms, like don't think this is like a dummies course or anything like that. Like the reality is that we will go deeper in the 102 and 103 and 104 sessions. But the most important thing for me today is immediately coming out of this session, starting tomorrow, you should be able to look at a heat map. You should be able to understand what you're looking for, what you're looking at, and how to apply it to your current existing strategy. Okay? Like if I go deep, then people are gonna get stuck in this rabbit hole and they're gonna be going crazy. Like I just don't want that for anybody, okay? So first thing first, Heatseeker is effectively a tool. It's a data module on the Skylit platform, which is gonna evolve into a much larger trading platform and terminal in the future. But what it does is it intelligently tracks and surfaces the dealer position and the dealer exposure across 300 plus tickers across the next five expirations. The reason that we're doing this is because over time and over the years, there's been a paradigm shift in the market where historically people had believed that the market moves the way it does because of supply and demand. And while it is true, that's a very, very oversimplified process and way of understanding it. There's actually a much deeper underlying reason why the market moves the way it does, okay? One concept that I'm going to go ahead and share off the bat is the concept of the stock market being a casino. Um, and the market dealers, the market makers are considered the house slash casino. And on the opposing side of them, you have the player or the gambler. Okay. So it's a double-sided market. And the reason I have to share this is because like the stock market really truly is gambling, especially when you're trading options. The good news is that there is an edge that the player or the gambler that can have, which gives you a potential advantage in actually beating beating like other people in the market, okay? So in the Heatseeker view and in the view of Skylit, ultimately the markets move the way they do because dealers are forced to hedge the bets that are made by the players. Okay? So as a player and a gambler in the options market, you make directional bets. You either go long calls, you go long puts, or you can go short calls, or you can go short puts, right? Generally speaking, you're looking for a directional move. If you think the price is going to go up, you're going to buy calls. If you think the price is going to go down, you're going to buy puts. Okay? Now, this is the most important part to understand. The mechanism behind what actually happens when you buy a call is that in a lot of scenarios, the person selling you that call option is going to be the dealer or the market maker. So just remember this. When you're buying a call, there's somebody out there that's providing that call option for you, okay? Which means that they are taking the risk because when they sell to you a call option and the price of the call option goes up because the stock goes up, they're potentially losing money and they're going to be underwater, right? So for that reason, they protect themselves, and this is called a hedging mechanism. And in order for them to remain neutral, which is generally what dealers want to do because they don't make directional bets and they more so make money off of like, providing liquidity in the form of, making money on the bid-ask spread or on theta, they mechanically must buy stock. So, for example, if they sold you, one call option, for example, like they actually have to buy shares of the underlying or like, SPX futures in a sense, so that even if the price of the stock goes up, they're not necessarily losing money because they own shares of that particular stock that is also going up in value, even though the option contract that they sold you is also going up in value, ultimately leading them being underwater on it. Okay. So what Heatseeker is doing is it's tracking this forced liquidity. Like we're not predicting what traders want to do. We're more so tracking what dealers are forced to do because this is more so a concept in the market and a mechanism that is non-negotiable. It's like if you're thinking about what players and gamblers are going to do, like it could be very, very subjective. And if you're trying to predict what whales are doing, um, like you're guessing, right? But when you're able to understand how the mechanics of the market work, and if you're understanding what the dealers are forced to do, you actually have much more of an ability to predict and forecast what is going to happen to price in the market as it approaches certain key levels. Okay, this is why Heatseeker is important. This is why it works. This is why the data that we provide is very, very critical. Okay, so what I will do next is I will go ahead and screen share what the current tool looks like. All right, so this is what the tool looks like currently. I think a lot of people have access to it. If you don't have access to it, just go ahead and follow along and you can take a look at what I'm showing. This is what the initial like main dashboard looks like when you log in. Um, there are two different things. One is called net gex, which stands for net notional gamma exposure, and the other one is called net vex, which is net notional vena exposure. Okay. Um, who the fuck is drawing on my screen? Hold on. Got it. Got it. I see. Yeah, Diana is drawn on my screen. Anyways, so we've got the net gex here. This is like a net notional gamma exposure. Like if you're on this tab, what you're effectively looking at is more so like, shorter term predictions in terms of where price is gonna go. Gex is most powerful within like the 0 day to like 5 day range. Because gamma is always strongest the closer to expiration you are. Net vex stands for net notional vena exposure. You can go ahead and do some quick research to understand what that actually is. But vex is effectively how delta changes relative to changes in IV and volatility. Okay. Yeah, Diana, no worries. I assumed that was on accident. You're not drawing like a dick or anything, so it's okay. Um, but yeah, for the sake of the conversation, like the way you can think about it is if you're using Skylit or if you're using Heatseeker, you can use NetGex primarily for like day trading or shorter term swing trades. And if you want to look out into the future and if you want to look for a way to identify like good swing opportunities and swing setups, you can go ahead and look at the net vex. There's only one scenario or two. There's only one major scenario in which net vex can actually kick in sooner than within the first 0 to 5 day period. And that is generally when you see a major spike in volatility, which is the VIX. If the VIX is shooting above 20 or if it's going towards like 25 or 30, GEX kind of ends up taking a back seat. And then you have the VEX taking a much stronger role in terms of how price moves around, okay? So for anybody that has the web application or tool, for the sake of like ease of use, like you could just use the Command G and the Command V to quickly switch between the netgex and the netvex. Over here in this little drop down, if you press slash, it automatically opens it up. You can effectively see all of the different tickers that we support. If you hit the left arrow or the right arrow key, you can just flip through them like really, really fast. Um, there's something called the king node. There's a notion of king node, okay? And the notion of king node is being able to see the particular expiration and strike where you see the heaviest amount of net notional dealer exposure. So it's almost like a very, very key area of interest and the node that is most likely for price to gravitate towards. And when you flip through the map, like we have some automation set up so that naturally what happens is the map will go ahead and auto scroll, for example, to where the keynote is. Okay. So something like a firm, what you're seeing is that the price is currently at 64. You've got a node all the way up here at 80, which is kind of interesting and suspect. Like that's a pretty big move. Like this could actually be a good setup to watch this week and next week, I would say. Um, but ultimately, the king node is at 80. The current price is at 64, highlighted in gray here. What this ultimately indicates is that as price goes up towards 80, the likelihood of us being able to go up and hit that particular price point only grows higher and higher. Okay? So the key thing to understand is that these are targets for this particular week. So if you look at the top here, you see November 28th. So the keynote for a firm is on December 5th. So what this doesn't indicate is that tomorrow is going to hit 80. Okay? What this does indicate is that by December 5th, there is a potential for a firm to approach almost near 80. Okay? So just keep an eye on this. Don't take anything I say as an absolute. Like it's not an absolute, and I'm going to explain why a little bit deeper, okay? But this is effectively this is how you use the map. Like you can just scroll through them, you can go ahead and see what the nodes are. In terms of the colors, the yellow is positive exposure, okay? And the purple is negative exposure. Um, I have something called a Greek Bible here. Like I'm going to go ahead and release this a little bit later once I actually finalize it. It's not fully complete yet, but for the yellow node, this means that dealers are long gamma. And the only, like, the major difference between like yellow nodes and purple nodes, which is like, positive gamma exposure versus negative gamma exposure, is how price reacts and responds to moves going towards it, okay? So if you see a yellow node at 80, for example, on a firm, and price is going towards it, what you're gonna end up seeing is the dealers ending up in a buy dip like short rip regime. Okay, so it's not gonna like just shoot up explosively like crazy, but what you will see is that as price goes up and approaches it, any dips that happen are gonna get bought, and any rips that happen are gonna start selling off. So it's kind of like a slow, like choppy motion upwards towards 80. Okay, for dealers being short notional gamma exposure, where you've got like a king node that is purple, it is a pro-cyclical price movement, which means that if there is buy happening, then dealers have to buy more into it. And if there is sell action happening, dealers have to sell more into it. Okay. So it's pro-cyclical, meaning dealers are generally moving in the direction of where price is going. Um, so this usually ends up in moves that are a lot more volatile, that are a lot more aggressive. Naturally, what you see with purple nodes is like, for example, if, let's just say the 65 wasn't here, and you've got a node up here at 70 that's like purple, and this is a lot larger, like negative, like, 2 or 2.5 million or something like that, right? as price approaches it, what you will notice is that it would happen a lot faster and a lot more aggressively. Like, these moves can be very, very fast and aggressive. But at the same time, if it's going up and then it rejects, that rejection can be very, very aggressive as well. Like it just whips around like that. Whereas a yellow node, it kind of goes up like this and you get movement like this, okay? Like it's a little bit more stable and steady as you're approaching it. Yeah, don't full port Affirm tomorrow, but it's something to keep an eye on. Like, if I'm looking at this Affirm map, like the way I'm looking at it is you've got 63 as like a major negative Gex level. Generally, what you could do is see this as like a support level where you're like, okay, like as long as this level holds, like I'm okay riding this to the upside. And what you would do is like you would buy the dip towards 63 and then you would try to ride this back up to like 80. Like you can get calls for like next week or you can get lottos for this week or something like that. But yeah, you guys are all still new, so I would just be very, very careful initially. One thing that I do need to note is that when you're looking at the actual exposure levels, generally what I like to see is 4 digits in front of the decimal. Like if you've got 3 digits or less in front of the decimal, like it's just not as reliable as a level, and it's not as high of it's not a ton of exposure to kind of work with is pretty much what I'm saying. Like my rule of thumb is like I usually want to see like 4 digits or more in front of the decimal. All right. So again, like the repeat that I'm gonna have is like yellow nodes, which is something I call beacon nodes. Like they generally are more dampening in terms of the volatility, and the purple nodes are gonna be more pro-cyclical in terms of how price moves. Okay. Tidon, like what it means if the yellow node has green nodes surrounded by it. Like, let me try to find an example, but let me try to find a good example real quick. Yeah, so if you look over here, wait, where the fuck did that meter go? Okay, yeah. So if you look on the top right over here, you can actually see that we have a gauge that we're using that is used to kind of determine the color of the nodes. The very, very bright yellow is like the largest positive exposure node that you're seeing. If you're seeing something that's green, like it's still in the positive area, but it's just not as strong of a positive exposure as the yellow. So dark purple is like the most negative, very, very bright piss yellow is the most positive, and then green and blue is like kind of in the middle, which is just not as strong as like the yellow and the purples. Okay? Oh man, everybody and their mama's gonna be buying a firm tomorrow. That's not good. But yeah, anyways, like the one thing that's going to be important that I need to share is actually this is a great point to give this disclaimer, but um, I always encourage anybody that's using Heatseeker, especially in the beginning of their career utilizing Heatseeker, to always prioritize price action. Okay? Like number one, most important thing to prioritize is going to be market structure and price action, which means you should be pulling up your charts and you should be charting it first to make sure that it validates that the setup is good. Like even if there's a major node that's yellow to the upside, if the price of that ticker is like really, really extended and it's already at all-time highs with like, like it just looks gassed out, like there's probably a high probability that the price is not going to actually hit that upper node, okay? So let's just go ahead and pull this up for like, the sake of looking at a firm. Like let's take a look at what it looks like, okay? Um, all right, this is generally what I do. Like I just open up my chart, I take a look at it, and what I will do is I will just clean my chart clean. And like let's see how a firm looks like. It would zoom out to the weekly. I'm like, all right, looks decent. It still looks like it's in a bullish structure, right? Because we've got this still looks like a bullish structure to me because we've got a high right here, we've got a low, we've got a higher high, a higher low, higher high, higher low, right? So it's still in a bullish structure, which is like a good sign. And if you zoom out to the daily, like the only things I really use for TA, like I don't really use RSI, I don't use MACD, I don't use Bollinger Bands, I don't use any of that crap. Like the only thing you really need to draw is like your major support and resistance levels. So for example, like you've got a pretty big resistance level right here, like I care about that one. You got a pretty strong like pivot right here. This one is strong in particular because you've got a resistance here that eventually turns into a support here. It became a resistance here, and then we broke back above it, right? So in my opinion, like, I mean, ideally, if a firm ever came down to 52, like, I'll definitely be buying it. But if I look at the next support level up from there, what I'm generally seeing is like this one right here, right? Like, I guess we can go ahead and draw it all the way through here. But the 62 level is like a pretty big support level, right? You've got support right here. It used to be support right here as well. Um, and you kind of got support right here. So usually what I do is I will look at it and I'll be like, okay, it looks like it wants to go up to 80 by next week. And look what you have here, like right near 80, like you have a major resistance level right here, right? There is a support, it became resistance. It became resistance here again. It became resistance here again. Like that level has been tested so many times. So generally, after I look at the heat map, like what I'd be interested in doing is I would be interested in buying the dip towards the 62 level. And as long as 62 holds, like I'm looking for a ride back up towards the 80 level. And what does this give you? This will give you a risk to reward level. All right. Like let's say let's just put our stop loss like below the low wick right there. Okay. This gives you a risk to reward level of 7.62. That means it's a 7 to 1 or an 8 to 1 risk to reward. If you could find any setup on Heatseeker and your chart that gives you a 3 to 1 risk to reward level or better in terms of swing trades, like you take that every single time. Okay. This is not financial advice, but what I'm saying is that as long as you're looking for the setups that give you a 3 to 1 risk to reward ratio or better, you will be you'll be very good. Like that's ideally what you want to do. Like don't go for the 1 to 1 risk to reward ratios. Like the reason why I like the snipe reversals and the reason why Heatseeker is so powerful is because you are able to identify asymmetric risk to reward setups, which means your downside is limited and your upside is pretty much limitless. I mean, not necessarily limitless, but it's like a lot more upside than downside, okay? All right. So yeah, I think a firm is like a pretty decent play right here. Like I mean ideally, you would have entered last week on Friday off of like 61. Like this is a pretty nice level. Like I just never had time to look at it. Um but yeah, if we get any kind of dip in the market, it looks like it's about to reverse back to the upside, then a firm is a pretty strong pick of mine that I have on watch. Um One thing to keep in note with regards to all of the tickers that you're trading is don't fade the market. Even if a firm looks incredibly bullish, if small caps and if like, the S&P 500 is showing downside or if it's showing a lot of weakness, like a firm is not going to be able to hit 80, right? Like if the market is holding everything down, even if there are nodes to the upside on Heatseeker, like there's no guarantee that they're going to be able to hit, okay? So, yeah, I'm already in. I've already got 100K in this bitch. How did I calculate risk to reward? There's this tool right here on the projection tool. Like click on the long position button here, and you'll be able to calculate it. All right. I'm pumping a firm right now. That's what I'm doing. All right. But anyways, like that's actually a live example of like how to kind of use the heat seeker and the charts in real time. I think the most important thing that everybody here has to understand is that like when you're using heat seeker, like you have to use it as a supplementary tool and a complementary tool to your existing strategy and how you already trade. Like if you're like Glitch and you've been using this shit for like 12 to 16 months or almost 2 years, like you don't even need the chart and you could just use this raw blindfolded and you'd be able to make and bang out profitable trades. But nobody is at that level yet, okay? Like even later when you start trading like SPX religiously, like I know people today that are very, very successful trading SPX without looking at their chart ever. They will literally just look at the heat maps or go to Trinity View and like they would literally trade off of this and they can make money. The reason I don't recommend it is because nobody is at that level yet. Like new tools take time to learn. Like there's going to be a lot of confusion when you initially start. And I think the most important thing you have to do is like make sure you're managing risk appropriately. Like don't just blow yourself up in like 1 or 2 trades, okay? Like that's the most important thing. Like this is gonna end up becoming a risk management session because when people get new shiny tools in their hands, what they effectively do is they think it's a lotto ticket to becoming like, the richest person in their network of friends. In reality, it's not. Like a lot of times when new tools are introduced to you, you actually decline in terms of your overall performance because you're adding something new and it can go ahead and confuse you and trip you up. But it's more so like a slingshot. You take a step or two back, but then you learn this new way of trading that's like inevitably how the market moves and reacts to, dealer hedging, and you have a successful career going ahead. Okay? So, another thing that I have to go ahead and note is when you're looking at the heat maps, just because like wait, why is it showing arm over on SPX? Okay. All right, let me just pick an example of another map real quick that's like clean. One of the rules that I outlined to everybody is to never go into the habit of node chasing. Like just because there's a node that shows up that's like, like let's use like BMNR for example. Like for the first column, November 28th, what it shows a bright positive yellow node here at 26, and it shows a negative one here at 30. So when I'm looking at this one, immediately what I'm noticing is that our range for the week is going to be here probably down to here, okay? So this is the range that I'm seeing. What you don't want to do is see BMNR go up here, and you're like, oh shit, this is going to hit 30, and then you're going to go ahead and enter this trade and chase it up to 30. You do not want to do that. And the reason you don't want to do that is because your upside is going to be 1.5 points, and your downside is going to be 2.5 points, right? Like that is a negative risk to reward trade. Like you're risking a lot more than your potential gain is, right? But if you're looking at this and you're like, okay, like let's say BMNR does go up to like 27.5, but it comes back down to 26 or like 25, right? This over here should be your entry. Like you should enter off of 25 with the intent of riding this back up towards 30 or riding it back up towards 33. Because then what is your risk to reward? Even if you are willing to hold it with 24 as your stop loss, your upside from here is going to be 8 points. So you've got a massive risk to reward to the upside as opposed to like your downside risk, right? So one thing I encourage everybody to do is when you're looking at the nodes, the first thing you want to do is you want to identify the potential range. You want to identify the potential range. This is the key. And number two, what you want to do is you want to ask yourself, where is the entry that I can snipe that will provide me with the best risk to reward ratio? Meaning my upside is much higher than my downside. Okay. And this is like, there's a contrarian way of trading, and like this is why it's very difficult for a lot of people to actually be successful in the markets. Like everybody that learned to trade through like Thurus or like Discord servers that have no idea what they're doing, they learned to chase and they learned to follow the trend. So what people do is they wait for like EMA crossovers, or they wait for like MACD crossovers, or they wait for a confirmation of breakout. And what they do is they jump on the trade after it has actually run a bit. And as you're seeing, the problem with that is that you're pretty much chasing price rather than letting price come to you to your point of entry that gives you a really, really cheap entry to write it back up or write it back down and vice versa. Like the way to become a successful trader is not by doing what the rest of the herd is doing. The way to become a successful trader is to understand what the rest of the herd is doing and don't do what they're doing. Okay? Like you want to enter with institutions, you want to enter with whales, you want to buy low and sell high, you want to short the highs and you want to cover low. Like this is the most important thing that you have to understand, where if you don't grasp the idea behind this, first thing first, you're not going to be getting the most out of your usage with Heatseeker. And number two, you're effectively going to be with the rest of retail. Like you're just going to be getting clobbered left and right, okay? So again, like this is a good example of a map. What I'm telling you is that these major nodes that you're seeing, these are your walls. Like these are your invisible walls. Whereas the price approaches it, there's going to be a high chance of price deflecting or reversing from there back to the upside. Or if we go up towards 30, there's going to be a high chance of it deflecting to the downside, okay? So don't chase nodes, all right? You want to play the node deflections and the node reversals so that you end up with the highest risk to reward ratios, okay? Like this is the most important part. Like risk to reward and identifying like asymmetric setups is the most important thing that people overlook. And the reason it's overlooked is because everybody is like they're learning from the wrong people. Like they're learning from the people that are selling you retail indicators and like they're telling you like, oh, wait for confirmation. Like, oh, you can't predict price and you can't predict where the market is going to go. Like the reality is that Heatseeker is literally like a fortune teller or like a fortune cookie that's telling you where dealers' hands are going to be forced into buying or selling more shares. Okay? Like that's the most important part you have to understand. Like when you understand what dealers have to do and when you know what's in their hands and how their hand is going to be forced, you can actually front run the market and understand what's going to happen to price before it actually happens. Okay? Yeah, you're literally counting cards. Like that's the most important part. Like let me actually show you an example of um like let me do a few examples of this, okay? Like maybe we could do NVIDIA as an example. We could look at the replay for we could look at the replay for this day, right? No, 14th, what the fuck? We're gonna look at it for the 21st, okay? All right, so when you look at the 21st, this was right at the open, right? This was a very, very clean map. Our buddy Guillermo called this one out, and I think it was an incredible trade. Like, it's like he knows how to use these maps really well, and I thought like he had a pretty clever trade on Friday, and this is how he played it. What we saw is that 185 was the top of the range here. It was negative 23 mil, and what we saw is that 170 was the low of the range here, right? Like this is a 15-point range that you could play with, and over here. This is something I call an air pocket. Air pockets are where price can move through like really, really fast because there's barely any like hedging obligations at this level. There's barely any hedging obligations at this level and barely any hedging obligations at these levels, okay? The ones that you care about most are 170, 175, 177.5, 182.5, 185. So effectively, when you're looking at this map, there's a couple of ways you could play it. You could play it off the rejection of 185 down, or you could play it off of here and back to the upside. Okay. So let's go ahead and see how it played out. Also, one thing to note is, as I was mentioning, the yellow nodes, which are like the king, like Pico nodes, or like the volatility dampening nodes, like there's no guarantee that these nodes are going to hit, especially if it's the yellow one, because price gets dampened as it's approaching. So if you're ever short in this particular trade, first thing you want to do is as it approaches 175, since there's a pretty decent position here, like you can hit some turbulence and you can take some trims. But especially if price is going towards 170, like by the time you're at like 172.5 or 172, like you should already be trimming out because this is a dampener down here, and there's a high probability that it's going to reverse from here before it actually hits. Okay? I'm not saying that's always the case. What I'm saying is that you shouldn't be greedy to make sure that, like, you shouldn't be greedy and wait for these nodes to get fully acquired. Like, there's no telling when it's going to reverse. Like, another reason why 170 might not actually hit to the downside is if QQQ and SPY end up bottoming and reversing before this node is tapped. If SPY and QQQ are going down and they reverse aggressively back to the upside, then this 170 is going to be a bust, okay? Now, I wasn't in this trade, so I don't remember how it played out, but let's go ahead and take a look real quick. You can use the replay tool. You could put this on like 2x or 5x, and like let's see how it played out. All right. Think so. Right out the gate, like you got pretty big, pretty good dumps down to like 174. All right. Yeah, I think maybe the 2x is a little too fast. Actually, this might be a little bit easier. Let me go ahead and share my trading view instead. That way you can follow along on how I would pretty much watch it from a charting standpoint. All right, we're gonna chart up NVIDIA. Go to the 3-minute chart. So on Friday. Yeah, so you got Friday here. So Friday's here. So earlier what you saw is you had a node up here at 185. You had one at 182.5, right? I think it was 182.5. Yes, you had one at 182.5. And then you had one down here at like 170. You had one here at 170. And then where was the other one? And then you had a minor at 175, right? So effectively, what you could do out the gate is, so right out the gate, like the market actually did look pretty bearish. So what you could do is you can either short it from 182.5, that node, with the stop loss at above 185, and then you can write it down from here, right? But what you notice is as it hits 175, it goes down a little bit further. And as I was mentioning earlier, like the yellow nodes, like you generally don't want to wait for them to fully hit. The probability of it actually fully hitting is like it's not always maybe 100%, right? So as it's approaching the 175, like you actually want to be taking profits into these red candles that are actually dropping below that price because there's always a probability that price can get caught up on that 175 node and start reversing, right? Also, let's go ahead and take a look at what time NVIDIA reversed. This was at 10:39 Eastern Time, and let's go ahead and pull up QQQ and see what it looked like at 10:30, 10:35, right? So QQQ also hit a bottoming pattern here. So naturally, like even if NVIDIA wanted to go lower towards that 170, it wasn't actually able to. And let me go ahead and zoom back out to the heat map for QQQ, and let's go ahead and see how we could have identified that the tech market was actually going to start reversing at that point. So this was at 10:36, right? All right, let's see what our QQQ looked like on 10:21. That was at like 10:36, right? All right, so even QQQ, look at this. So QQQ, like this is actually a very, very interesting map. Like there's literally no other tool on the market that was going to tell us that QQQ was going to hit 595 or 596 before the close. Okay, like let that be known first. Right when we opened, this is your upper range right here, okay? And to the downside, this is your major like negative exposure node right here. Okay, so for the day, you can kind of assume that you would have a 15-point range to play from. Like that is a massive, massive range. The two things I'm thinking about in order to understand how I'm going to play this is if right out the gate, if we pump up towards 595, I'm going to go ahead and look to short that. But if out the gate we're dipping towards 580, I'm gonna be looking to go long from 580. And the reason I'm gonna be looking to go long 580 is because if you're able to buy the dip at 580, your upside is 15 points. Even if you had a 2 point like downside risk to reward, that is a massive, massive risk to reward setup. It's got to be like a 7-1 or an 8-1, okay? Like if you're seeing a setup like this and you're not buying the dip as the price is going down towards 581 or 580, like you are a pussy. Like you take this trade every single time. And like I don't know if this is exactly what BM saw at the gate, but what I remember him saying is to turn your notifications on for Trump, saying that there's going to potentially be news on Trump. And I would imagine that because he's looked at the replay so many times, right out the gate, he already knows that people are stacked up here and there's a major level of interest here at 595 and 596. Now, the one thing that you have to remember and note is that this is showing net notional gamma exposure. There is a Greek called delta. It's a first order Greek on all options contracts. And generally speaking, what's going to happen is that if price goes up towards this, these are going to become stronger and stronger. But if price initially diverts from it, these are going to become weaker and weaker. That's how gamma exposure is actually supposed to work. But just because this becomes weaker doesn't mean that it can't come back to life in the future, right? The reason it becomes weaker is because the delta on these contracts is reducing and reducing as price diverts away from it. But what's going to happen if price diverts away from it, but it reverses back to the upside? These are going to become strong again, right? So what he's actually like what BM is probably doing is he's probably front running the idea of these dormant nodes coming back to life even after price comes all the way back down here. Okay. He probably also saw the Nvidia node that was showing 185. So when Nvidia dumped all the way back down to 172, what he was thinking is like, okay, Nvidia is gonna have a fucking 13-point run going into the close. Okay. Like the combination of those two things is like how you can kind of front run the market and understand like how the dealers are positioned and how price could potentially move. So let's go ahead and look at what QQQ did. All right. So even like, man, this is like six minutes into the open. Like, look how strong these nodes got. They almost doubled in size each, right? So that's a really, really good sign. But you still don't want to take a trade here, right? The reason you don't want to take a trade here is because you got 8 points to the potential downside. Over here, you've got 7 points to the potential upside. This is only giving you a 1-to-1 risk to reward ratio, right? So it's kind of in the middle of like the major levels, and like you don't want to take something like that. You want to take something that's going to give you a 3-to-1 or better. So right off the bat, if I'm looking at this, I'm like, okay, if it goes up towards 595 to 596, I might go ahead and take a short. If it goes down towards 580, I might be looking to take longs. Okay, let's see how it played out. All right. So right at this point, okay, this is a very, very important key note to take into consideration, okay? These nodes up here, they became dormant, right? The reason they became dormant is because prices drifted so far away from them that their deltas are almost near zero, and dealers don't have to remain hedged for those anymore, or their hedges are a lot less. What that doesn't mean, though, is that they're going to remain dormant, okay? One thing that we're noticing here right off the bat is bare minimum, we should be able to see a potential move back up to at 585, right? And you've got a floor of 580 here. Even if you had a stop loss down here at like 579, you've got a 1 point stop loss right here, and you've got the potential for 4 points up to the upside, which is a 4-to-1 risk to reward ratio. You take these. You take these, okay? Then you've got a 590 node here, which inevitably you know as price goes back up towards 585, this one is going to start lighting up. And as price goes up towards 590, these ones are going to start lighting back up, okay? So let's go ahead and see how this played out. Let's see if that's indeed what it did. All right. Look at that. Like even after it bounced only 2 points, these nodes just come right back to life, right? So first thing first, as it's approaching 585, what I'm saying is as it's approaching 585, like you take trims, like you could take trims and you could take partials, but you should always leave runners if you can afford to do it, okay? So 585 hits, and then look at these growing back, right? So this is the part of the missing puzzle, and this is what people don't truly understand about gamma exposure and like dealer hedging, that people that have watched the replays over and over understand and can grasp the concept of. Remember, the purple nodes amplify volatility. You've got a double stacked purple here. So as it's approaching here, it's going to approach it very, very fast. And let's go ahead and see if it actually did. Let's see. This is at around noon. I'm going to flip back to my trading view chart now. And let's actually see what happened at noon. All right. So this is right around 12. So you had the 580 right here, right? And then you had the 585, somewhere right here. Okay. Then you had the 590. And then you had the 595 and the 596 and the 597 right there. And then 597. Like remember, right as the market opened at 9:30, there was already signs that we could potentially go all the way up to this zone right here. There was potential to go there. If you go anywhere down here, this is the dip you want to buy, right? So, as I was saying earlier, like you saw me walk through the heat map, right? What I was saying is if we buy the dip towards 580, as long as we stay above like 580 or 579 probably, like I'm looking to stay in the trade. Okay, so like let's say we entered there. Like let's put your stop loss at like 579. Okay. So at 585, you've got around a 2.36 to 1. Over here, you've got a 5 to 1. All the way up here, you've got something like an 8 to 1. Like an 8 to 1 risk to reward ratio, like you got to be crazy to not take the odds like that, right? Like these are the perfect types of asymmetric setups that I'm looking at. And not only was this reversal beautiful, like look what else you got afterwards. Like you got this massive squeeze candle. Like remember what I'm telling you, if there's two double stacked purples up here, like this shit is gonna happen fast. And like it literally happened in one 3 minute candle. Like sure we got news, but like you literally have an opportunity to front run the news. Like people know these news drops are gonna happen and like you're able to kind of foresee, forecast, and understand like the moves before they actually happen and take place. Even if you missed this pump all the way up to 597, you have an opportunity to even short it there. Like it was literally a perfect short from 597, like this 595 to 597, and it dropped around 7 points, which is an incredible risk to reward ratio right there as well. All right, so I'll stop sharing the trading view real quick. Let me just go over. There's like 63 comments I haven't read yet. So 1 second. Yeah, Heatseeker, like the good thing about Heatseeker is like even for me, like the biggest advantage I got from it is knowing when to sit out and knowing when to step in. Um, and it helped me become a lot more patient because I was being a lot more like I was scrutinizing my trades and plans a lot more, where I have data to work off of, and if the data shows me that I have an edge, I'll go ahead and take it. And on the days where the data is like, yeah, you don't really have an edge, like this is just a shitty overall day, and like you don't have the good risk to reward setups, like I just won't trade. And like I'm fine with that because I know Heatseeker's not going anywhere, and the maps can reshuffle through the day. And even if I don't get a good setup in the next hour, like maybe once everybody's back from lunch, like a new good setup is going to present itself, right? Now, one other thing to keep note of, when you're playing off of double tops, double bottoms, the chance of price bouncing from a double top or a double bottom is 66%. The chance of it bouncing and reversing from a triple top or a triple bottom is only 33%. Okay? So even if you're playing a node deflection on a heat map, you want to instill that same ratio. If a level is being tested for the first time, that could be a great opportunity. If it's getting tested for the second time, that can still be a great opportunity, 66% chance of a reversal. If it's getting hit for the third or fourth time, you want to either size down significantly or you just want to go ahead and sit down. Because even if there's a major node that is indicating price can get deflected, because of the probability of that level breaking through or like, deflecting being only 33%, you want to be very, very careful and cautious. Like, I think the common trap that a lot of people run into is they'll see a major level, they'll doubt that price is going to reverse from that major level because they are just doubters, and then they'll miss the bounce. And they'll be like, "Fuck." Like, well, I don't want to chase. Like, let me go ahead and get it if it comes back down. Then it's gonna come back down, and then for some reason, like they're on a phone call or they're in a work meeting, and they're like, "Fuck, I missed it the second time." And then they're really pissed because they missed it. They missed the same opportunity the second time. They're gonna see that price approach the node the third time, and they're gonna be like, "Fuck it," because I missed it the first time and the second time, and I missed all of that theoretical profit. I'm gonna size heavy on this one and make sure I come out nice green on the trade, and then the price will just fucking blow through it, and they'll get destroyed. Like, don't be that person. Like, be very, very patient. Like, the market will present you opportunities every single day, every single hour. There's so many tickers that you be trading. The last thing you want to do is FOMO trade. Like if you're a FOMO trader or if you're a revenge trader, like, nothing is going to be able to help you. Breadman can't help you, Glitchy can't help you, Heatseeker can't help you. Like those are inner demons that you're gonna have to overcome and like fight the battle with. The good thing is that Heatseeker, like if you use it religiously, like it helps you become a lot more disciplined because you're like, yeah, this is clearly not a good setup. Or you'll be like, okay, like if I do take this one, I'm gonna scalp it because the range to the upside is very, very low. Like the good thing is that like helps you understand what trade you can stay in a little bit longer versus what trade you just take for a 30 to 50% scalp. Like you have to be dynamic when you're trading. Like you can't have like one single monotone way of trading and like expect that to work in every single market condition, okay? Yeah, the Heatseeker charts in the Discord are same. They're coming from the same backend as the software, so they should still be accurate. The SPX and the SPY and the QQQ and IWM maps, I will have the Discord maps firing every 15 seconds. What that means is that the data is live, but there's going to be a 15-second gap between when the next map is going to post. Um, and that's ultimately just to make sure that things are fair for the people that are paying for the software. Like, I don't want to just give out like all the sauce for free because like people pay big money for this, but there's a reason they do it, right? So for the bakery, what I'm gonna do is, in light of the partnership and just because I love the community, like we'll go ahead and leave the maps open for the entire week, um, because I don't want people to think that it's only gonna be open on Tuesday and then they're like, oh fuck, I have to make a trade on Tuesday, right? Like just observe, play small on Monday and Tuesday. You got it on Wednesday, you got it on Thursday, you'll have it on Friday. So like just don't rush into things and like don't be greedy and don't be retarded, okay? Like that's the most important thing. Like just don't be stupid. Yeah, the Heatseeker and all of these Excel spreadsheets crack me up because just the data cost alone to run Heatseeker is easily like 70K plus a month. Like no cap, I can literally show receipts. Like shit is very, very expensive. Yeah, don't get into the habit of node chasing. Like that's the most important thing. Like I think a lot of people are still in this mindset of like chasing price and like reacting to price. Like all of the people that say like don't predict price, react to it. Hey, just like follow the trend. Like those people are saying that because they don't have a tool as powerful as Heatseeker in their hands that help them identify the areas where dealers' hands are going to be forced to either increase or decrease their hedges. Like you literally know the pressure points in the market, you know the invisible hands in the market. That's the most important thing. Just because there's a node somewhere doesn't mean that price is automatically going to gravitate towards that node. It just so happens that in a lot of scenarios that is the case. But what the nodes actually represent is where the pressure points in the market are, and once the price approaches it, where pressure can actually start being relieved. And that's why I say play node deflections. Like that is what's going to give you the best risk to reward setups, okay? Like that's the most important thing that people have to know. Hold on. Yeah, so the net vex on the future, like the most important like the net vex works in the future because like like dealer hedging the volatility is like very, very sensitive, like the further dated you go. So generally speaking, like I would say it's pretty predictable. The only thing that I would be very, very cautious of is that the nodes on the third Friday of every month represent operate it's called OpEx, but it's generally like your monthly contracts that always have like the highest volume of traded contracts, but it also has like the highest like chance of like manipulation happening. So when we're looking at the major nodes for the weeks of OpEx, what I generally tell people is to just like trade them very, very cautiously. Like I think that's the most important thing. Like you just want to be cautious, you want to be careful, and just be skeptical of it because like OpEx as a whole, um, there's a ton of manipulation going into it. And the thing you have to realize is that even if the net vex looks good for December 19th, as the price gets closer or the day gets closer to December 19th, within like that 0 to 7 day left to expiration, the GEX is actually going to start taking over. So at that point, like you don't keep on looking at the net vex, you have to flip your mindset into being like, okay, like gamma is becoming stronger because we're getting closer to expiration. The gamma flows are going to start dominating price. And like you just have to be fluid and understand like when to flip on like your gamma hat versus your vena hat. And like that's the most important thing. All right. But for a lot of people that are asking like how to identify like the best swing trades, like generally my rule of thumb is to buy it off of gamma floors for like the current week and then look at the Vanna maps. And if the yellow nodes are like up and to the right, like a stair step up into the right pattern, that's generally like a very, very good potential swing setup because you're buying it off of the lows for price for the week. But going into the future, the VEX is pointing up and to the right, meaning that there's a high probability that you can see potential upside. Again, like the thing I need to keep on iterating is like even if these individual tickers look good, just try to line them up with how QQQ, SPY, and SPX and like IWM and the VIX is looking. I would say for the VIX, like we were in a window of weakness going into November 17th. That window of weakness slightly lets off, but going into mid to late December and January, we could see a spike in volatility again. And what that means is that like everything can go to shit. So just be very, very careful. I would say if Thursday's lows hold, the Bulls have a pretty good chance at getting a nice relief bounce. And in my opinion, going into January, we've got another window of weakness coming. It's probably a lot of potential like economic news impacts, or it could be like the C wave down and an ABC corrective wave. I'm not entirely sure, but like that's my overall read on the market right now. Yeah, the dormant nodes, like I'm thinking of a way to go ahead and get this done. Like we are thinking about it. The only reason like it's a little bit risky is because like it kind of diverts away from like how gamma exposure is supposed to work to begin with. So at that point, like I don't even know if I would call it like I mean, even the data we have right now is not like vanilla Gex and it's not vanilla Vex. Like everybody thinks it is, but I guarantee you it's not. Like we have our own like proprietary unique inference model that effectively takes in data from like four different major sources, and we pre-process that data and we post-process that data to come up with our assumption of what the dealer exposure actually looks like. So like all of these other crap tools on the market, like they claim to know like what dealer exposure is, but they're just using a very naive like vanilla formula and calculation they find on ChatGPT or Google, and they're very, very terrible assumptions. So I mean, first thing first, like I'm no grifter here. Like, why would I be charging so much for like something you can get for like 50 bucks a month, right? The reality is that those tools don't have an edge because they're just using a public formula. And why would dealers or why would Wall Street want to expose a public formula that gives retail traders an edge, right? It just doesn't make sense. Yeah, a lot of people that use Heatseeker get the hang of it, say it feels illegal, and they say it feels like a cheat code and a hack. Like the thing that I want people to know is like a lot of people like they start using it and then it's very easy for them to get overconfident and they're like, yeah, this shit fucking works and like I'm literally gonna crush it. But like there's no absolutes in the market. Like the market is always based off of statistical probabilities. So what you want to do is you want to take the setups that give you number one, very, very good risk to reward. And number two, you just want to play probabilities. Like you don't want to go ahead and play absolutes. So rule number one, don't ever fucking full port anything. Like if you like that is the dumbest shit anybody could do. Unless you're playing a challenge account just for the hell of it, and whatever like dollars is in your challenge account is like less than 5% of your net worth. Like in that scenario, like go ahead and full port something. But please, if you're gonna full port your entire like net savings or like your life savings or something like that, like the stock market is not for you. Like just go to Vegas and go to the casino and blow it that way. Like you will literally get destroyed like playing the full port strategy in the market. Like take this from somebody who's done it in the past many, many times. Like I'm a very optimistic person. Like when I was in the lab, like initially developing Heatseeker, I was so infatuated by what we've developed, and I was like, yeah, I'm gonna go ahead and do all this dumb shit. And like, yeah, I did some pretty dumb shit. Like sometimes it worked and sometimes it didn't. For a lot of people that ask like, hey, what's the success rate? Generally, I say it's anywhere from 70 to 80% in terms of if you're taking the entries as you should be taking them, then your win rate should probably be anywhere from 70 to 80%. Again, one very, very, very important thing that you have to realize, because I know a lot of people are going to be trading SPX zero day expiration here, is that SPX zero day expiration is probably one of the most like it's definitely one of the most like disregarded strategies in the book by a lot of people that consider themselves a professional trader. And the only reason they say that is because like those people don't know how the zero-day expiration market works. We actually do because that is the regime and the era that we grew up in, and that is how we effectively learned to trade. Like I actually think that zero-day expiration is only going to become more and more popular, but as a result of it, the wealth gap is only going to continue to increase. What I mean by that is if you nail down how to trade zero-day expirations and like SPX, like you will become fucking filthy rich or wealthy in the future. At the same time, if you're breaking all your rules and you're doing dumb stuff and you're thinking of it as a get rich quick scheme, you are absolutely going to get destroyed and lose everything to your name. So just be very, very careful and like just don't be an idiot. Like like your membership to the bakery is only 40 bucks a month. Like you can literally get that back in like half a trade. So like don't try to like spend 40 bucks and be like I'm gonna make 100K this month. Like just pay 40 bucks a month and be like I'm gonna try to make like 1,000 bucks this month. Like think about your return on investment at that point, right? And anything more than that should just be a bonus. So just be very, very careful. A lot of people ask me like, hey, how do I properly trade like zero-day expirations for SPX? Like Breadman, like he might have a different like strategy and he might have a different suggestion, but I trade SPX zero-day expirations religiously. 85% of all my trading profits are directly from SPX zero-day expiration. The only reason I don't alert it and I don't trade it lately is because like all of my time is spent developing and supporting Heatseeker users. But the best SPX zero-day strategy to use and employ is to always size as your stop loss. What this means is instead of taking a $10,000 position and having a 20% stop loss on it, take a $2,000 position and let that go to zero because your loss is still going to be the same, right? Like if you did a $10,000 trade and you have a 20% stop loss, you're losing 2,000 max. If you take a $2,000 trade and if you have zero stop loss, you also take a max loss of $2,000. The good thing about the latter strategy is that you have a lot more margin for error and you can actually let your trade play out. The problem with taking a $10,000 position and having a 20% stop loss is that even if your entry is off by 3 to 5 points, your stop loss is triggered. Number two, even after you take the position, if the price moves in your intended direction, but it doesn't move fast enough, theta is going to kill your contracts and you're going to be down 20% and you're going to stop out, only to see the position go 300 to 500% afterwards. So, rule of thumb, when you're first starting off, especially if you're going to be a user of Heatseeker, let your size be your stop loss. Like just do this until you become more comfortable with it. As you become more precise in your entries and your exits, as you become more familiar with how to trade SPX and understand how SPX moves, then you can go ahead and double your size and put your stop loss at 50%. But I don't even recommend that. Like I just recommend always leaving your stop loss for SPX at 0% and having your size as your stop. If you play aggressive, if you go for the massive home runs, I guarantee you're going to regret it. Just remember, the better you become, the more risk you can go ahead and start layering and adding on. Okay. Luke, I see you asking questions with regards to like what strike prices to take. I think this is different for every single trader. Personally, like for SPX, like if you've got a bigger port, like people trade like at the money or in the money contracts, and like those can be anywhere from like 10 to 20 or 2,500. Um, For a firm, like, if the current spot is at 64, the keynote is at 80, and I'm looking to get something for next week, like, generally I look at the delta and I like to take contracts that have delta of like 0.25 or greater. That way, like, it actually moves decently well, even with smaller moves. If you're taking a contract that has like, less than 0.10 delta, you really need Gamma to kick in hard. And for Gamma to kick in hard, you need like a parabolic move or you need a much more like aggressive initial move. Nomadic, when I say waiting for reshuffling at open, how long does that shuffling usually take? How long to wait before entering trades? So the reason why I tell people to wait for reshuffling to happen at open is because dealer hedging doesn't start and the adjustment of rebalancing their books generally will not begin until after the market opens. So after the market opens, um, around like especially like large institutions and funds, like the most activity you see on their end is within like the first 20 to 30 minutes. And generally on the other end of those institutions and whales are going to be the market dealers. So naturally, like you see a lot of like rapid shuffling and movement within those first 20 to 30 minutes. That does not mean, though, that it's an absolute and you shouldn't take a trade within those first 30 minutes because some of the best opportunities could be like 5 minutes into market open or like 10 minutes into market open. I would just be a little bit more cautious and like I would size a little bit more appropriately within those 30 to 45 minutes because a map or setup that looks incredibly good can change up on you really, really fast depending on the movement of the whales and institutions within that first 30 to 45 minutes. Do we have access to Heatseeker to check for tickers we want to review? Yeah, we're going to be opening it up in the server for the following week, so you can go ahead and play around with it. There's going to be a bot in there as well where you can go ahead and pull the heat maps for, 300 plus tickers. You can also input the timestamp, so you can pull historical maps as well in case you wanted to do like a recap or a review. As a newer trader, how do you set up these rules for yourselves or just research? Jacob, like when you say newer trader, like I don't have too much context what that means. Like, are you new to trading options or are you new to trading like equities in general? Like, have you been researching the stock market for a bit? I think those are all important things. But yeah, generally speaking, like just a few words of wisdom and advice is try to understand what kind of trader you want to become. Um, the more aggressive returns you want, the more risk you're going to have to put up. The more conservative you want to be, the less your returns are going to be. It really depends on what stage of life you're in. Like if you're 22 or 25 and you've got, nothing to lose, then you could go for a much more aggressive strategy because you know you'd be able to get up afterwards. I know traders that are in their 50s or 60s where they've got like 50K to their entire name. And for those kinds of people, I always tell them to be a little bit more conservative because like they are not as likely to be able to start from the ground up again and rebuild, right? So I think everybody's going to have a different preference and a different style that they have to approach the market with. So ultimately, like it's all going to depend on that. Like I can't offer any advice there. I think it's all just very dynamic and depends on, what stage of life you're in. Yeah, Aaron, so yeah, generally with QQQ and SPY or even SPX not matching up, like this is the reason I have Trinity mode made available. Generally across the three maps, like if I'm seeing like QQQ and SPY approaching a floor together and SPX is showing a little bit lower, my assumption will be we will get a bounce, but there is a risk of that bounce fading and SPX wanting to go towards its lower node. Like I internally draw these narratives, but the thing is, if you're looking for alignment perfectly across all three of them at every single point in time, it is probably going to drive you crazy because you're going to miss out on a ton of good opportunities. So this is where I always say like use the probability spectrum and the probability aspect. Like if the probability of a trade playing out in the way that I wanted to trade is like 66% or greater, or like two-thirds or greater, I'm generally going to go ahead and take the shot. But if QQQ is showing that it's nearing a floor, and SPY and SPX both show that there's a lot lower to go, in that scenario, I will wait for SPY to hit the floor, and QQQ might overshoot the floor at that point, and then I'll go ahead and take the entry. Or I might take a very, very small trade or a lotto position, and I'll be like, fuck it. If it overshoots, it overshoots. But eventually I know the V reversal is going to happen, and I'll end up in profits. Also for SPX, like one of the things that I do is like I leave myself a lot of margin for error by not going into a full position right away. Like what I will do is I will go ahead and have some limit buys and like, I'll enter like one third of my size. If it goes down even more, like I'll go in two thirds. If it goes down more, I'll go in three thirds. That doesn't mean I'm averaging down. I generally never recommend people to average down. Averaging down is when you take a full position, your entry was not perfect, so you double down or triple down, which means that your risk becomes two times or three times what you wanted it to be. When you're taking my approach, which is scaling into a particular trade, if you're only in on your first scale, which is one third, and the price actually goes in your intended direction, you still made money and you still had skin in the game. But if your entry was not perfect and you have an opportunity to go in two-thirds, then you've got a lower average. And if you have an opportunity to go in three-thirds and your trade hypothesis is still valid, you reduce your average again, but you're still only max in what your position size should be. Okay? So don't average down, but a scaling strategy, in my opinion, is like, I mean, it's free game. Yeah, I mean, when I was trading like religiously, like sometimes I would take like 20 to 30 trades a day. Like I'm generally a scalper. I scalp a lot and quite often like I don't really do that great with swing trading. Like I just don't have the patience for it. So, yeah, sometimes I take like 20 trades, sometimes 15. Like sometimes I might take zero. I haven't really actively traded in the past 2 months because Skylit and Heatseeker has just been keeping me incredibly busy. But yeah, once I move to New York, like I'll probably start actively trading again. And like I'll do some live sessions and stuff. Yeah, and I'm telling you right now, I do scale in, but I don't like average down. Like I don't double down and triple down. Like I'm not a big fan of doubling down and tripling down. Like you shouldn't do that unless you've got fucking massive bankroll and you know what you're doing. Like averaging down in the sense of doubling and tripling and quadrupling is the best way for you to blow up because every time you double or triple down, your emotional tension will grow exponentially because the initial amount you were willing to risk expands by 2x and 3x and 4x. So at that point, you're trading based off of emotion, no longer trading off of logic and rationale. So I think that's the most important part. Young Buffet, you asked, should you look at the resistance level node grow if you're playing the call side? So generally, as you're playing deflections from nodes on the downside, you're not going to see the nodes on the upside growing until after the reversal happens. And like I did an explanation of why this is the case earlier in the video, so I highly suggest you watching the replay, which is why I always say play node deflections. Like you just got to grow a set of balls and mark the levels where you're expecting reversals to happen and you just have to shoot your shot. And then after the reversal takes place, the upper nodes will start accumulating, but there is a way to identify which upper nodes are going to accumulate based upon how the maps looked like in the morning. So you just have to go to you have to go through my replay later and like kind of watch how the QQQ map played out on Friday, and that will give you a very different perspective on how you can most powerfully utilize this tool. Yeah, I'll go ahead and upload this to YouTube later, so you should be able to see it. Yeah, Luke. Luke, do you have a $1 million port? If you, yeah, if I had a $1 million port, like I would probably allocate like 50 or 100K on a 0 day expiration trade. Like anything more than like 100K or like 200K becomes very hard to like start getting in and out of trades. Like sometimes I'll trade like 200 contracts and like I can't get filled all at one shot. So even if I have like limit orders set, like it just takes time for them to fill. And I'm not a fan of like market filling because sometimes you get terrible fills. Chavi, I don't really alert. That's not really my specialty, especially right now. Like I am pretty busy going to war with all of the other like tool providers and like platforms on the market. So I think next 12 to 16 months, like I'll just be locked in, continuing to add more value to the tool, and doing a lot more onboarding and educational content and like teaching people how to fish for their own. But I will do like some live streams, like maybe I'll do like one or two a week or something like that, where people can kind of walk through my logic and just get in my brain a little bit. Yeah, Fibonacci's are okay, but quite honestly, like I think just being able to identify like support and resistance and areas of liquidity are going to be a lot more important. Yeah, Young Buffet, like I guess that's a pretty decent way of thinking about it. Yeah, Girth, Wind, and Fire. We're going to be creating like a Heatseeker or a Skylit dojo, with like a leaderboard for people that like demonstrate their level of understanding and expertise with regards to Greeks and, Heatseeker and Skylit. So yeah, that's going to be a pretty fun, like gamified way of learning all of this. Like everything you learn today is like great to get started, but like there is a lot more that I could be teaching and educating on that's going to help in the future. But this should at least help you get started. What's the longest you can hold a zero to expiration without data completely fucking your trade? There's not really a theoretical answer to that because even if data fucks your trade, gamma grows stronger as market nears close. So like gamma can technically take the driver's seat completely and like your contract can easily go from like minus 80% to like positive 200% within like 5 minutes. Like that's the beauty of SPX, but that's why it's important to like give yourself like very, very loose stops and more margin for error. What the fuck? I'm not from India, bro. Khan is just straight trolling today. Yeah, I'm from Bangladesh. You can tell from my accent, right? Yeah, Mr. O, not on the recorded session, but I can go ahead and quit the recording and maybe walk you guys through a little bit after. Steve, when dealers are short gamma, that could be above or below. It doesn't really matter. There is nothing 100% guaranteed, Scar. Yeah, I can go ahead and shut the recording down for now, and like I can go ahead and share a little bit more information.